Kgotsong, dumelang. Today I will be doing tangible assets purchased, and as it says, purchased means there was an outflow of cash. Now, we normally use your tangible asset note. For you to be able to answer this thoroughly in your cash flow statement, you have to know your tangible asset note, which is note number 3. And here we'll simply be calculating the value or the cost price of tangible assets purchased, or simply calculated the selling price of tangible assets sold. The selling price of tangible assets sold will result in an inflow of cash, and the cost price of tangible assets purchased will result in a cash outflow. Sold, cash inflow at selling price; purchased, cash outflow at cost price. As I've said, in order for you to complete this note, you will need the statement of financial position for the current and the previous year, so that you can be able to determine whether tangible assets have increased or decreased. You will also need your tangible asset note. In most cases, they will not give you both. They will only give you one of the two. And your tangible asset note will look like this. Because we have purchased, everything will be in brackets, which represents an outflow. Now, we purchased the land and building worth 1.2 million. We purchased vehicles worth 300,000. We purchased equipment worth 250,000. So our total tangible assets purchased will be 1,750,000. All of these results in a cash outflow. Obviously, when you add them up, they will give you that 1,750,000, and that's what you will put under tangible assets purchased, which will be under investing activities in your statement of cash flow. The purchase of each of these assets will result in an outflow of cash, hence all amounts are shown in brackets. And sometimes we take what we learn in grade 12 for granted. I was just reading something. It was one of the questions from CFA, it came out in CFA level 1, where they said that you were giving a net profit before tax, which was around $1.2. And they told you that the depreciation for the year was $800. And there was an increase in trade and other receivables of $1,000. And then they wanted you to calculate the value of, well, it's cash inflow. Is it a cash inflow? Is it a cash outflow from operating activities? And that's what they simply wanted you to calculate. And it ringed the bell that this is level 1 CFA, and already you're learning it in metric. And most of you probably couldn't see South African education as very, very poor. But I mean, I managed to answer that question just using grade 12 knowledge. And this is level 1 CFA examination, which is highly complex. I think the pass rate for CFA, which stands for Certified Financial Analyst, it's an exam written in America for you to become a qualified finance specialist. And I simply managed to answer that using grade 12 cash flow knowledge. And you might take it for granted, but you do have a good system. And all you have to do is just to work hard to make sure that you do your best in achieving your ultimate goal, your ultimate dream, which is following a passion. All right. I think that is the only P we can be pushing right now, just pushing the passion all the time. Okay. Now, with your tangible assets purchased, I will encourage you to always use this table here as part of your workings. It depends on what you are given. It's either whenever you calculate any buildings, equipment, vehicles, just use this formula. And they should only give you one missing item. They won't give you more than two missing items. If they give you two missing items, they will give you enough information to at least calculate one of them so that you can be able to manipulate the formula and calculate what you need. Now, I'm just gonna show you how this works. Okay, I will start by working with cost. Let's say we're trying to calculate the value of equipment purchased, but we are only given cost. How do we do that? So when you're only given cost, when you use this table, your calculation table, your tangible assets purchased or sold calculation table, if you're given cost, everything will be calculated using cost. So if you're given cost, they will simply give you the cost at the beginning of the year. Additions will be at cost. Disposals will be at cost. So they must tell you what the cost of the item that was sold. So disposal must also be at cost. That is if you were given cost price. Okay, disposal must be at cost. When you are given the cost price, you will not have depreciation because depreciation doesn't affect the cost price of any item. And then at the end of the year, you only have cost price at the end of the year, and that's what you are going to use. So your formula will simply be cost at the beginning of the year plus cost at, well, additions at cost, disposals at cost. You won't have depreciation, and the last one will be cost of the item or of equipment at the end of the year if you were asked to calculate equipment, the cost price of equipment purchase. So if you were asked to calculate the cost price of equipment purchase, they'll probably give you the cost price of equipment at the beginning of the year. You won't have additions at cost. They will give you the cost of the item or cost of equipment that are sold. You won't need depreciation, and they will give you the cost price of all assets or all equipment at the end of the year. And then you just have to manipulate or just use the reverse operation to calculate additions at cost. Okay. Now let's say this is just hypothetical. Okay. If we were to calculate additions at cost, but we were only given carrying values, then everything must be at carrying value. So we just erase the cost part. So everything must be at carrying value. And so you will have carrying value at the beginning of the year. Additions will always be at cost price. You'll have disposals at carrying value. You'll have depreciation. And at the end of the year, you'll only have carrying value at the end of the year. So that is if they only gave you the carrying value of that specific tangible assets. So you just alter this formula to suit what you need. And you just need to pay attention to them, whether you were given the cost price of the items or whether you were given the carrying value. Now, let's say the carrying value of the item that you're calculating. It can be equipment, it can be vehicles. Please note that for land and buildings, it's quite easy because land and buildings will not have depreciation. Okay. And let's say carrying value was 1.2 at the beginning of the year. We don't know what our additions are. Disposals at carrying value was 500,000 and depreciation will be 100,000. And the reason why we put in disposals at carrying value and depreciation in brackets because they will reduce your carrying value that you had at the beginning of the year. At the end of the year, you will have carrying value will be 1.3 million. So you will just have to manipulate this to calculate the cost price. And to manipulate this to calculate the cost price, you'll have to use the reverse operation by taking 1.3, adding 100,000, adding 500,000, and subtracting 200,000 to calculate the value of X. And that's how you will calculate the value of X. And this addition simply represents the assets purchased, and it will be shown in brackets on the face of your cash flow statement. And this is how I calculated that 700,000. All right. Taking into account the carrying value or cost of the assets sold in the current year. If given the cost price at the end, at the beginning and at the end of the financial year, the disposal value must be at cost price. And that's what you need to highlight because it's very important. Take into account the total depreciation of the asset at hand. Now, I think they were supposed to be on hand. Now, note that depreciation will only apply if you were given the carrying value of whatever asset you're trying to calculate the cost price of, which was purchased in this case. Let us look at the first example regarding tangible assets. You are given information which is an extract from the notes to the financial statements of Dlamini Limited on the 30th of June 2021. You will note that the cost price of equipment, you only have equipment and vehicles. Vehicles is quite easy for you to calculate the movements. It's either the movements are additions at cost or disposals at cost, which is quite easy. The problem will only come in when you have to calculate additions of equipment. And I will actually do this quickly by simply recording the fact that the cost of equipment at the beginning of the year was 100,000. We sold equipment worth 18,000. So the cost price of equipment sold was 18,000. And at the end of the year, the cost price is 112,000. In essence, because we sold equipment, the cost price at the end of the year was supposed to be smaller than the cost price at the beginning of the year, but this is not the case. So you can simply tell that we actually purchased equipment here, and we'll get to it shortly. But let's quickly determine the movements under land and buildings. Basically, the formula that I just showed you earlier on is the same as your tangible asset note. It's just that I simplified it a little bit just to show it as part of your calculations. Now, when you look at land and building, the cost price at the beginning of the year is 400,000. There's no depreciation for land and building. There was no disposal of land and building. And at the end of the year, the cost price is 450,000. So what happened? It means we purchased land and buildings worth 50,000. Now, with equipment, as I've said, you can use the cost price to calculate this additions at cost. You'll realize that for equipment, in this scenario, I decided to use the carrying value first. Okay. Now, when you decide to use the carrying value, you will simply take that 74,800 minus 5,600 minus 22,000. And it should give you carrying value at the end of the year, which is 77,200. If it doesn't give you that 77,200, probably it'll be less than that 77,200. You will simply find the difference between the value that you have and that 77,200. And the difference there will represent additions at cost. All right. Or you can simply work with the cost price as I indicated earlier on. Now, if you were to use the cost price, as I said, you will take 100,000 when you minus 18,000, which is the cost price of the equipment disposed. It is supposed to give you 82,000. But you'll realize that the cost price at the end of the year is 112,000. That indicates to you that we purchased equipment and the value of equipment purchased will be 30,000 Rand. Otherwise, you could have just used what I showed you at the bottom there, which is at carrying value, by taking the carrying value at the beginning of the year of 74,800, you minus the carrying value of the asset disposed, you minus depreciation. That'll should give you the carrying value of 47,200, but it didn't. You'll realize that the carrying value at the end of the year is 77,200. That means under movements, something happened. And what happened under movements is that we purchased, the difference represents what we purchased, the cost price of equipment purchase, which will be 30,000 Rand. Now, to put this in your tangible asset purchased node, you will start with land and building. We purchased land and buildings worth 50,000. We purchased equipment worth 30,000. So our total tangible assets purchased will be 80,000. And that's why we're putting it in brackets, because it'll result in a cash outflow. Okay, try this quickly. Note that here we're given vehicles at carrying value. So when you use the formula, everything must be at carrying value. All right, so you basically will have to use the calculation table, and your calculation table will have to be at carrying value, except for land and buildings. Obviously, land and buildings, for now, for grade 12 level, it is calculated at cost price. Try it and check out solutions in the next video. Kgotso.